Good afternoon, everyone. This is Jeff coming to you from Live Traders on August 2nd. I just want to put out a quick little couple-minute video here. I sent this out before, but there's a lot of new people in here just to make sure we're clear on how the spread plays work outside of the SPX. So very quickly, it's going to have the date called, the date that we actually played the call, the expiration. Now, these are going to be different because expirations on the SPX typically are 1 day out, right? So when you have a expiration that's further out, then your price will not get killed by time as much. Although there is time decay, it's not quite as significant. So we have to use a different pattern in the sense of how we're using our stop. And I'll show you that here in a second. Amat will be the symbol. Bull put means we're selling the 134 puts and buying the 130s. Premium is above 70 is where you want to get filled. Could be 70, 75, 80. Again, there's no way to know exactly where you get filled, but I'm going to put 70 because that's kind of what gives us an idea. As long as it triggers 70 or higher, I'm going to figure that. Theoretical edge is based on over 11-year history that I actually run this data. It actually has performed inside of 14 days to expiration. It has been successful 93.8 of the time, 0.8% of the times, that far to expiration, it's been successful 93.8% of the time. So that's our theoretical edge, meaning that the actual theoretical part of this means that we are really, they say the value is about 63 cents. So if I get it at 70, I'm actually better by about 10.8%. So that, don't worry about understanding that, honestly. This is just kind of how some of the research I do when I'm getting these. The downside cushion means from where the stock price is currently trading at 143.88, you have a 7.10% down. It could be maybe, a 0.05 or maybe even a tenth off here. But basically what I'm showing is 7.10 stock price above the top strike of the 134. Expiration date, once again, is 8/20. There's 14 days to expiration. Earnings date, this is important because we won't be holding this past earning. We have to have an expiration, but I can't get the credits unless I go out to the expiration and find the data in there. So the earnings date is going to be 8/12. Will come out before then. The stop 50 delta, this is where most people have the issue. Stop 50 delta means the 134 strike on the put, you're selling the put up here, that's a 50 delta, which means so if I have a $4 wide strike, so if I divide that by 50 on the delta, that means I have a risk of $2 per contract. But I was credited 70 cents per contract, right? So it means I have a risk of it's actually $130 per contract. So let's say you want to have your risk at, hey, I want a $250 risk roughly, let's say, per each one of these. Then you would actually, your stop would be when the stock price hits 134, you're going to see that this will actually be 130 per contract, or in that case, $260, okay? Again, these are a little different than the SPX because of the way that theta comes in. We will not be holding this to expiration. We will not be holding the earnings. We're typically going to sell out this probably about a dime, maybe 15, maybe even 20 cents based on what the charts look like. So I'll update you as those get near that. So basically, if you have a 130 risk, you're going to risk at the 134 delta, right? You're going to risk 130 bucks. Now, potential loss per contract, right, is the $4 spread minus the $70 here of the credit is what? $330. So if you let this thing go beyond, when it go beyond the 130 put, the buy put, and expires down there, then actually you would have $330 per contract risk. Now we're not going to carry it to expiration. Even if you were below that before expiration, it still wouldn't be $330. That's only at the close of that, and we're not going to hold it to the close. I have to put these numbers exactly as they would be, but they're kind of worst case and never will ever get that far. But just know this, the 130 per contract is the delta 50, the stock price. So when that thing's trading at 134, I need to be getting out of the position. So we're using stock and the option to determine what that rate of risk is per contract. So again, if I divide the $4 spread of 134 by 130, Okay, I divide that by 2, which is how you do that on a Delta 50. Means I have $2 exposure at the Delta 50, and I add my credit back in. I means I have $130 risk per contract. Okay, now likely this is one that we're gonna feather with stops. We're gonna lower our stops and go break even, and then maybe get out at a dime or again 15 or 20 cents. So these are different. Just be aware of that. These don't have the same nomenclature. You don't have, typically you wouldn't use $1.40 as your stop going backwards. You wouldn't say, well, I'm in at 70 cents, 2 times my profit is 140. All right, that's or 280. That's not necessarily the way that we're doing these, okay? Because theta is not kicking in here. Now keep in mind, our win rate will not be as high on these, but but we won't have, but we don't have to have that batting average to make a sizable amount of income in this type of spread trade. Bottom line is that we have a long way down to cushion here. We're on tech side, and obviously we pull back. As long as the market, hopefully stays somewhat moderately bullish in here, then this will be fine. But that's kind of our cushion to the downside. So, all right, thanks guys. I hope that helps. Any questions? Let me know. Talk soon. Bye bye.